Welcome back in. It's time to talk about your money, and particularly if you are in your 401k, you're invested in the market. You know the market, it goes up, it goes down, there's volatility. So how do you weather that to build wealth? Joining us this morning is Marshall Clay. He is with the Welch Group, and he got some advice on this. Good to see you this morning.
Good to see you.
Yeah. You know, when a lot of people think of somebody like a Warren Buffett, who's got tons of money, as we know, in his investment in the stock market, they think, well, he's one of those that just times the market. But that's perilous for somebody who's trying to build a financial future. That's not what he does.
You're exactly right. And so over the past 10 years, we've been very fortunate to have relatively low levels of volatility. Mm-hmm. We've seen that volatility tick up over the last 12 months or so. Yeah. And so it's really important for sort of your lay investor to really kind of understand how they're prepared and if their mindset is correct for the potential increase in volatility that we're probably expecting in the future.
And we may get some of that volatility some more because of what's happening with the trade tariffs with China. So what should be our approach then? What should be our mental and our investing approach?
Yeah, so the first thing that everybody wants to do is set and actually commit to financial goals. I mean, that is the foundation on which all of our future financial decisions are made. Okay. Once you do that, you kind of know where you're going and you can establish a plan.
Give me an example of committing to a financial goal.
I mean, really, a great one is, when do I want to retire, and how much money do I need to accumulate so that I can retire at that certain date? That's the big one that I see most often.
All right, so if you're not going to time the markets, then what should you do?
Well, you mentioned Warren Buffett a minute ago. The thing that he probably does better than anybody is manage risk. Okay. And so what he does, and what I encourage a lot of our clients to do, is look at what their financial goals are first and foremost. So go back to that first rule, and then take a really conservative approach, or take the most conservative approach that you can possibly take, but still meet your goals and objectives. So what that allows you to do is it gives you exposure, or enough exposure, to the stock market in order to get that upside potential, but then also limit downside risk. And so what Warren Buffett does so well is he's identifying value to the point where he's always got enough dry powder or enough conservative investments on the sidelines that when opportunities present themselves, when there's big market volatility swings to the downside, he has a lot of money to go in and buy those assets at very low valuations.
So he's got money in money market funds, or he's got capital there, leaves it on the sidelines, but all of a sudden when the market starts to go down, he says opportunity to buy stocks of reputable companies are not going to go out of business. Say like an Apple, or that's the best one I can think of. Microsoft maybe would be another one.
Absolutely.
Okay.
So it's counterintuitive. When the markets are dropping, most of us get afraid and we decide, hey, we're going to sell out. He's doing the exact opposite. Gotcha. So that should tell you something. All
right, real quickly, because we have to wrap up. Avoid comparisons to benchmarks. Talk about what you mean there.
So we're humans, and we love to compare ourselves to other humans and other people to sort of get our sense of value and self-worth. That's a pretty dangerous thing as it pertains to the stock market. The financial media typically bombards us with Dow Jones Industrial Average returns, S&P 500, NASDAQ, you name it. What they don't mention is that those indices are fairly risky indices. And so what I tell clients is, don't measure your stock market performance against a benchmark. Measure it against what your financial goals are. If you're meeting your financial goals, don't be lured into a riskier or to comparing yourself to a riskier benchmark, which could put you behind the power curve when we have those big downside volatility events.
All right, Marshall Clay from the Welch Group, appreciate the money advice this morning.
Yes, thank you.
All right.